All right, everyone, welcome. So this is, I've never done these videos before. So this video is going to be basically, so we did a story where like a lot of new traders, like, they followed me. I've gained a lot of new followers as well, but they all had these basic questions about trading. And that's what we're going to answer. And the way I'm going to answer is like my buddy right over here. So he knows what the fuck I'm talking about. And then you guys, this is just going to be for all you guys. So the first question was from a guy called Face of Meme, and the question is, prop firm or a small size live account? This is prop firm or a small size live account. So here's the thing, right? Now, when prop firms did come in, their whole idea was really good, right? The idea was that you could get a large account for a small fee, and once you get that account, now you can make some gains, you can trade however you want, and then you'll be able to make some money by withdrawing profits, right? Amazing concept. And a lot of new traders really flocked to that. I think like a lot of guys from underdeveloped countries or like, who don't have enough money and they want to trade that large account, those people, like this concept appealed to them the most. But what ended up happening is, and which I also know happened, was because like a lot of people, like the percentage of people who do pass a 100 account and they would move on to a live account is small. So I would say maybe start with a small live account, right? That's going to be better because at the beginning, what's going to happen is you may see this large account and you may want to go with a prop firm account thinking that you will make money. But man, listen, what are the odds? If you're not profitable on your small account, how are you going to be profitable on a large account? It's just not going to work because there are some people who are profitable. I'm not going to say they aren't. They are profitable. They've done like six-figure withdrawals, like $500,000 withdrawals, so on and so forth. But starting with a live account is way better. Even a small account. What my advice to everyone who just wants to go into a prop firm account is going to be start with a $500 account. Right? Start with a $500 account, start with a $1,000 account, and then look at the challenge that you want to buy at a prop firm. If that challenge is worth, let's say, $500, so all you can do is you can say, okay, I'm going to grow my $1,000 account, and I'm going to grow this account to $1,500. I'm going to withdraw $500, and then I'm going to go buy that challenge account, right? That's an even better idea. So I think that's going to be the best thing you can do because in that way, you're proving you are profitable, you're proving you are consistent, you're proving to yourself you are disciplined enough to actually withdraw money, and then with that money, you're buying yourself a challenge at prop firm. Okay, so the next question is what to check in volume to enter a trade. Now, when people ask me this question, I think that they think there's something on the chart which they can look at and say that, oh, okay, now we have volume. That's not the case. It's not like you can look at a chart and say, oh, maybe there's volume now. You can't look at a chart at 1 p.m. Eastern time or 2 p.m. Eastern time and say, oh, there's volume here. No, that's not how it works because it's not like you're looking at a chart, you're looking at the clock. When you're looking at the time, you're seeing that, okay, if it's 8 a.m. Eastern, there's supposed to be volume now. If it's 9:30 a.m. Eastern, there's supposed to be volume now. Let's say if it's pre-London time or it's London time, then there's supposed to be volume. Because it's not like you can look at a chart and say, oh, like, you know what, I have these volume bars open and these volume bars are saying there's volume at this time or like there's no volume here. Well, no shit, Sherlock. If you're going to look at a chart at 3 p.m. Eastern and you're like, oh yeah, the bars tell me there's no volume, of course there's no volume. Because you have London closed, you have European closed, you're moving towards New York closed, there's no Asian session, and these guys think that there's going to be volume at that time, but looking at a fucking chart, there's not going to be any volume at that time. Because whenever you're looking at those little bars at the bottom of the chart, those are volume bars, right? Those volume bars, they basically form once a candle closes. Right? So imagine you got a candle and the candle is closing a big bullish candle and you're looking at the volume bar, you're like, oh yeah, there's a lot of volume now. Now I guess we can take a trade. But in reality, if you're not looking at the candles themselves, if you're not identifying what's the probability of a next candle to continue bullish or bearish with a big size, if you don't know that, volume is not going to help you. Volume is just going to tell you the volume there was in the previous candle, not in the coming candle or approaching candle, unless you are aware of the time that you're looking at the charts, right? Because you can only look at the charts around, let's say at NY Open or pre-London or London Open, Asian Open. Those are the only times when there's going to be volume in the market. Other than that, you're trying to look for volume on the charts because, you're at a grocery store and it's 4 p.m. Eastern and you're bored, your mom's picking some stuff out from the shelves and you're looking at the charts and trying to see if there's volume. There's no volume, buddy. It's not going to happen. And that's the beginner mistakes I used to make in the beginning too, right? In the beginning, when you're looking at the chart and you're in drawdown and you want to open up a position just before market close, no, does not work well. Does not work well, right? So listen, whenever you're looking at the chart, before looking at the chart, pick out something, whatever, and open up Google and start to ask market sessions. What session are we in? And then that's going to tell you if this is a time when there's supposed to be volume or not. All right, so let's take a look at this over here. This is a question. Question is, why sometimes do you take a trade without waiting for the candle to form a top or the bottom wick? The question was in some broken English, so I tried to make it as good as possible. And for that, I'll take you to my iPad right over here. So imagine, let's say, you're looking at the charts and you have a bearish candle forming like this, and then you have another bearish candle that forms like this, and then you have some sort of a bullish candle forming, and the candles start to form or whatever, right? Now, the question is, why do you take a trade before the candle forms a top or a bottom wick, right? Which means, why do you take a trade before you wait for the candle to close? Because if the candle hasn't finished making a top or the bottom wick, then this means the candle is still open. So which means, why am I taking a trade before waiting for the candle to close? Now, the main reason why is because of impulse entries, right? So whenever you're looking at impulse entries basically means when you're taking an entry as soon as the next candle starts to break the high of the previous candle, or you take an entry as soon as the next candle starts to break the low of the previous candle. That's the reason why. Because, in the beginning, when I started to trade, they told me, all you have to do is, Raja, just wait for the candle to close. And when the candle closes, that's going to be a confirmation. And based on that confirmation, then you can take a trade, and then price is going to go wherever it wants to go, whether to stop loss or to profits or whatever, right? But in reality, what ended up happening was, which happens to a lot of other guys here too, is that as they're waiting for the candle to close, or as we are waiting for the candle to close, because this still happens to me, as we're waiting for the candle to close, the candle starts moving. The trade keeps running, right? And the trade keeps running, and we're like, oh shit, man, I've missed my move. I should have taken the trade. And what ends up happening is you take a buy. Let's say, like, I'm imagining price moving up as I'm waiting for the candle to close, but it keeps moving up. And I'm thinking, oh shit, I've missed the trade. And then as price moves up, I take a sell at the top. As I take a sell at the top, price starts to retrace, and now I'm in instant drawdown, right? So I'm like, okay, how can I solve that problem? How can I literally solve this problem? And the problem was that, okay, imagine that I'm looking at a support formed, and we all know a support is formed when we have a bullish candle forming after a bearish candle, as long as the trend is bullish, because we're buying supports in uptrends and we're selling resistances in downtrends. Don't tell me otherwise, because I'm not going to listen to that. Now, imagine you have a support right here, right? And you're anticipating the next candle to close as confirmation, because now some of us are here who look for those extra confirmations, right? You look for some extra confirmations sometimes, right? Sometimes we do look for extra confirmations. So maybe as we're waiting for the next candle starts to move up, and it starts to break the high of the previous candle. As it starts to break the high of the previous candle, now you're thinking, should I take a buy right here or not? Or should I just wait for the candle to close? Now, let's say you're one of those very conservative traders who will say, okay, you know what, I'm going to wait for the candle to close. You're waiting for the candle to close, and the candle keeps moving and moving and moving, and it closes right up over here. And you're waiting the whole time. Right now, since you are more smarter now, so what you're going to say is, you're going to say, okay, you know what, instead of waiting for the candle to close, I'm going to enter a buy as soon as it breaks the high of the previous candle, because I've seen this happen a lot of times and I've missed the move. And there's this Raja on YouTube, he's taking these impulse entries on Instagram and whatever. So, you're like, okay, let me take a buy right over here. You take a buy, as an impulse entry, and price starts to move up, candle closes, you get some, let's say like 15 to 20 pips if you're trading gold these days, and you're like, okay, oh wow, perfect, this worked, right? This worked. So this is where you begin to understand that, okay, you know what? I'm probably better off in executing an impulse entry, not all the time, sometimes, so that I don't have to wait for the candle to close as it starts to move bullish, or as it starts to move to a point where I thought it's going to move, right? So I hope I answered your question. I think that was a very, very good explanation of like, you know, why I don't sometimes wait for the candles to close. So let's take a look at this next one. Yo, by the way, listen, I've heard that there are 88% people who are not subscribed to my channel. So subscribe now, like the video, because man, listen, the only payment you have to make for this valuable knowledge is just by liking and subscribing. That's it. Let's get back to the video. All right, so this next question is, why did you stop trading your large account? So it depends what you mean by large. My previous account was around 1.2, 1.3 million. When we moved to CTrader, I took it upon myself to grow a smaller account. In my case, the smaller account was $10,000. We grew that to $100,000 within a month's time. And then we got some comments about saying, okay, like, you know what, it's a large account with a $10,000, you grew it to 100,000. How about you do it with a smaller account size? So then we started a $1,000 account. And that $1,000 account, I think it's now at 2,600, 2,700. There's going to be something here on the screen somewhere. You'll see the growth of the 1,000 to where it's at now. And that comes in the right time, because at the same time what we're doing is we're launching Market Fluidity University. So as we're growing this account, so our goal is to take this account from 1,000 to 10,000, following the rules and the concepts of Market Fluidity University. And that would also be a case study to say, okay, like, you know what, everything that we teach in Market Fluidity University, we used all that, dumped all that knowledge in this $1,000 account, and look where it's at now in, like, you know, 4 months or 5 months. But the end goal is to get it to $10,000 and actually donate all those funds to some charity, or like, you know, some food drive or whatever that we can find here in Dubai, right? So I think that serves as a double purpose on why we're now starting like a smaller account to trade, just to see where we can take it following the concepts. Okay, so this next question is actually very important, and I think a lot of traders go through this. I think you've been through this as well, buddy. And the question is, why placing your stop loss after break even is important? Because sometimes it hits break even, and then later hits take profit. So what this means is, like, let's say we have a support, and you have a candle that came down, and then you have a bullish candle that closed, and then, you know, the next candle is starting, and you take a buy. You've taken a buy, and as price moves up, you bring your stop loss to break even. Okay, now you've brought your stop loss to break even. Next, now what happens next is that the next candle starts, it hits your stop loss at break even, and then it continues to move up. Okay, it continues to move up. Now, the reason why this happens is, now so this is a two-part answer, right? The first answer is, wherever you're going to have your stop loss, you've made a conscious decision that if your stop loss is at a point where you think it should be, and if price comes and hits that stop loss, that means price is doing exactly what you thought it would do. You know, it hit your stop loss, and the system is recognizing that your stop loss is here. The system will take you out of that trade. Okay, now once your entry is at a certain point on the chart, and you're saying, okay, like, you know what, there's I'm going to place my stop loss at break even. You got to ask yourself this question: technically, is that stop loss at a correct place? That's the most important thing. Technically, is your stop loss at a correct technical place that price should not go below that area if you're looking for a buy, or above that area if you're looking for a sell, right? That's the first thing you want to ask yourself. If you think that your stop loss technically is at the correct place, then price will respect that area. It's not going to hit it. It's going to continue to go wherever it wants to go. But if your stop loss is at your entry, and your entry is not at a technically correct level, then there's a high probability it's going to hit your stop loss, right? And quite honestly, if you're going to have your stop loss at break even, this means you're accepting the fact that if price comes back to break even, it should trigger that stop. at your break even because you're accepting that fact. So whenever you're going to have your stop loss at break even, it means you're accepting that break even outcome. So what can you do? Now, I can't force you not to move your stop loss, but what I am going to tell you, what I do all the time, and a lot of our profitable students like this guy right over here, we do this all the time, right? We do this all the time. And the thing is, whenever you're moving your stop to break even, always secure some positions. Whenever you move your stop loss, just secure 90%, secure 50%, 40%, whatever. Just secure something, right? Because if you're going to secure something, as you're trying to move your stop loss to break even, and now you've put some money aside, you're going to be much more confident in that trade. Then you're not going to worry about, oh, you know what if my stop loss gets hit, at break even and this and this and that, and you're going to say, oh, wow, here we go again. Why does this happen to me? Because you've secured some profits, right? So next time, whenever you want to move your stop loss to break even, just secure some profits and let the rest run. That's what I did in the beginning all the time, and then my confidence increased in my analysis, because then it comes down to how fast you can increase your confidence. And the speed at which your confidence is going to increase, it all depends on how much are you securing. Because the more you secure, the more confident you get. But the more you let go of, at even break even or like at a loss, your confidence is just going to get lower and lower. So it's very important. So always secure whenever you move your stops to break even. So this next question is, what do you suggest is a good enough capital to grow a personal account? 5K, 10K, or 50K? Now, I don't know why would you even put 5K with 50K and 10K. I don't know. Like, let's say if I'm going to say the best enough capital to grow a personal account is 50K. What are you going to do then? Are you going to go ask for a loan for 50K? No, absolutely not. So what I would say is, whenever you start into trading, there are two mentalities people come in with. The first mentality is that someone comes in with, they're going to come in and say, okay, like, you know what, I'm going to treat trading as a savior of my financial problems. I'm going to treat trading as a savior of my financial ruin, of all this debt I have, for all this money I owe to people. Trading is going to solve all those problems, right? And the second mindset is going to be of a person who's going to say, okay, you know what, I have 10K in savings, or I have 5K in savings, and I'm going to put something in this trading thing, and this trading thing is going to kind of like, I'm going to treat it as a hobby, and if this hobby starts to pay me well enough, more than my job, or equal to my job, or even 50% of my job, I think then that's worth it. Right? That's a really good approach. But if you're coming into trading with the first mentality, that trading should save me from financial ruin, man, trust me, you're in for a fucking kicking in the ass with the market, because the market is not going to give two fucks about what you think, what your problems are, what your debts are. It doesn't matter. It doesn't matter. And the second thing is, you have to really ask yourself. You have to ask yourself, what amount can you put into the markets? What can you really start with? Can you start with $1,000, right? Like $500. I started with $200 in the beginning, and then I deposited like $1,000. So you have to understand, like, what amount can you realistically start with? I would say, if you ask me, I would say it's $5,000. 5,000. We have leverage, and like $5,000. I think that's a very optimal amount, because quite honestly, of all the traders watching me right now, if you had a $5,000 account, right? If you had a $5,000 account, don't you think you can withdraw at least $1,000 a month? Let me ask you this, Caesar, don't you think?
Yeah.
Right?
Yes.
You, like, from a $5,000 account, you can easily withdraw $1,000 a month, and that goes a whole long way, because an average person who's watching me now, their monthly pay is maybe, let's say, like $3,000, not more than $8,000 or $9,000, not more than that, right? So if you're getting that extra $1,000 added to your monthly income, man, that's huge, because now realistically you can upgrade your lifestyle by $1,000. You can get that nicer car for an extra $100, or you can get that faster internet for an extra $100. You can put $500 to saving, and an extra $500, you can do whatever the fuck you want. So it depends what you want to come in with, because a lot of guys are going to say, okay, like, 5,000 and then 1,000 a month. It's not like, we don't want that. It's too low. We want more and more, because these guys on Instagram, they're making hundreds of $1,000s or $10,000. Like, you don't know, right? So in the beginning, come in with, let's say, I would say like even $1,000, $1,000, $2,000, and aim to make like small amounts. You know, you don't have to put in 10,000. You don't have to put in, like when guys come to me, like, you know, obviously we have a brokerage here now, and when guys come to us and say, hey, we want to deposit $100,000 and then we're going to trade that. And we say, hey, listen, don't come in with $100,000. Come in with 50,000 or come in with 20,000, 25,000. See how you feel. See how you like it. And then you're going to be able to tell yourself, okay, like, you know what, do I want to really deposit more or should I just go on with what I have? So it's very important. I would say maybe in the beginning, start with $1,000 and have like a smaller goal. If you're not going through the funded firm route or like a prop route, then if you just want to go in with a trading route, I think it's going to be better to go with $1,000, $2,000. Aim to make like $300-400 a month, right? $300-400 a month. And once you can actually withdraw that, going to my first point, right? First point in the beginning, if you can actually withdraw, let's say 500 a month, 1,000 a month, take 500, 400, 300, and go buy a prop challenge. Because again, going to my first point, now you've proven to yourself you're disciplined, you are consistent, you can withdraw money, and you're actually mature enough to actually trade and withdraw money at the same time. Now when you go to a prop firm, you're going to be able to perform at a much higher level and make much bigger gains. But if you're just going to come in with like a small amount and just start to gamble away, man, it's not going to work.